Twongeye kubasuhuza nanone. Thank you everyone for joining us. My name is Immaculate Businje. I am always honored to share with you in this community education. Tonight we have a focus on many steps we tend to forget before choosing life insurance. Like many of you saw on the flyer tells us like before you choose any of your health insurance coverage, understand key factors like learn your financial needs and long-term goals, what comfortably fits within your budget, your appropriate coverage limits, and the coverage options you have. Most of the time, when we are learning about life insurance, or we learn about the coverages we have, we focus on possibly a big amount we have to get for our families. Should I get $1 million protection? Should I get $2 million protection? Should I get a permanent life insurance? Should I get a term life insurance? But mainly, what we have to focus on, what do I need as a family? What does my family need? What is my affordability? What can I afford? Do I need a protection for 20 years? Do I need protection for 30 years? Just maybe to make sure that my home is paid up. Do I need a protection to make sure that my kids are done with college? Or do I need to make sure that my whole life and my family is covered for the rest of our lives? So before you choose that coverage that you need, I usually tell my people there is no bigger coverage, there is no smaller coverage. What is important is what you need. Gusubiraho mu kinyarwanda ku bantu bacu nanone turabakiriye. Ikiganiro cyacu cy'uyu munsi cyari kiri ku ingingo z'ingenzi twifuza ko twese tujya tumenya cyangwa twitaho mbere yuko turebera hamwe ku bwishingizi dukwiye gufata. Ese duhitamo ubwishingizi dukwiye gufata kubera ko twifuza miliyoni 10, miliyoni 5, miliyoni 2? Ese kanaka yaba yarafashe miliyoni najya niyo nifuza, cyangwa arambwira ngo nifate miliyoni? Ese naba nshingira kuki kugira ngo ndebe ubwishingizi bw'ubuzima nafata cyangwa se nafatira umuryango wanjye? Mu kiganiro cy'uyu munsi kuri Furaya mwabonye biravuga ngo mbere y'uko ufata ubwishingizi banza umenye ibyo wowe n'umuryango wawe mwifuza cyangwa se mwifuza guproteja cyangwa se kurinda. Ikindi urebe ubanze wibaze cyangwa wowe n'umuryango wawe mwibaze ngo ese ubushobozi bwacu bugarukira hehe, cyangwa se ubushobozi bwacu butwemerera gufata ubwishingizi bumeze bute? Kubera ko hanze aha byaba byiza twese tubashe gufata ubwishingizi bwa miliyoni 10 kugira ngo ningira ibyago nkarwara cyangwa se nkitaba Imana, umuryango ngusigire miliyoni 10. Ariko si ubwo bushobozi bwo gufata miliyoni 10 ndabushoboye? Ikindi nacyo ukavuga ngo ese naba mfite amahitamo yo mu bwishingizi nafata? Ese niba nifuza kuba wenda nafata ubwishingizi bw'imyaka mike nka 20 cyangwa 30 kugira ngo mbashe kuba namaje kwishyura inzu yanjye cyangwa abana banjye bamaze kujya kwiga, ese nafata ubuhe? Muri uyu mugoroba turaza kubaganiriza turebere hamwe nka community zacu nk'uko bisanzwe dufite amahitamo menshi, dufite uburyo butandukanye. Nta mpamvu yo gufata ubwishingizi bwa miliyoni utayishoboye, wafata ayo ushoboye. Ya need cyangwa financial need umuryango wawe ushoboye gufata. Icyangombwa gufata ibyo umuntu ashoboye ubashije kwishyura, kuko iyo ufashe ubwishingizi kimwe n'ubwishingizi bw'imodoka iyo utishyuye barabukata. Bivuze rero ngo byaba byiza ko umuntu yafata ubwishingizi ashoboye mu kigero cye, mu bushobozi bwe, kugira ngo cya gihe nikigera amikoro yabaye meza abashe kwiyongera. Nababwiye amazina yanjye nitwa Immaculate Businje, ndi financial professional. Mpora nishimira kuba namwe mu kiganiro nk'iki twigira hamwe nk'imiryango yacu mu byaduteza imbere n'ibyafasha imiryango yacu. Kandi nkaba ndi kumwe na engineer Collins Ntwari, tuza kuganira muri iki kiganiro. Ni financial professional, nawe ni umujene muramubona, akaba ari uyu adufungurira ikiganiro twinjira mu kiganiro nyirizina. Collins, please, the floor is open.
Murakoze cyane Immaculate Businje. Thank you all for joining us today. And the topic of today's discussion is risk architecture. We'll be looking at financial protection across life stages. Mazina yanjye ni Ntwari Colin. So tonight is simple. This is not about selling you a product. It's about thinking clearly. Most people work hard, really hard, to build wealth, to store up money, but very few people stop and ask themselves, is what I build protected? If you build a house, you don't just build and buy furniture and put inside the house. You have to first build strong walls and a gate and a fence to protect your furniture and all the valuables inside the house from elements and anyone else that might want to come and take your valuables. That's what risk architecture means. It means you build strong structure first and then growth. So most plans today, they focus on saving and investing. And that's good. But saving money and protecting money are not the same thing. Okay, let me explain. If you have $50,000 in your 401k, and then God forbid you pass away tomorrow, all your family will get is $50,000, and that's it. But what about the next 20 years of income that you could have earned if you were still alive? What happens to that money? That money is gone. So savings, they grow slowly, but protection can create money instantly when it is needed. Savings build and protection replaces. So we need to remember that building wealth is step number one, and protecting it is step number two. And once you understand that, you start asking a different question. Insurance pricing is not really complicated if you come to think of it. It mostly depends on two things, your age and your health. And both of those two things only move in one direction. You never get younger, am I right? Health usually becomes more complex over time. That means that protection is cheapest when you are young. And this is not pressure, this is just pure math. The earlier you act, the more choices you have. So remember, time does not make protection cheaper. And the sooner you act, the more choices you have. And that leads to the real question. What do we actually protect? What do we insure? You may ask. Well, we do not insure anything and everything. We insure what you would not not want to lose, something that would hurt you badly if it were lost. If something would cost you $100 to fix it, and you can insure it for just $1, doesn't that make sense? That is what we call risk transfer. So instead of you carrying the big risk alone, a large company comes along and carries it for you. You pay a small, steady cost to avoid a large surprise. Many of us have cell phones, and when you first get a cell phone, you buy a case protector or a screen protector. That's maybe $20, $30 to protect you in case you ever drop that phone and have to pay $800 to replace the broken screen. And the phone alone is probably worth $1,000, maybe more. So think about it the same way. You pay a small cost for big protection. That's the idea. Small protection is not about fear. It's about balance. Do I want to pay a lot, or do I want to pay less and let someone else carry the heavier burden? As most coverage ratios is 1 to 100. This means that for every $100 of risk, you only pay $1 to cover for that 100 risk. If that risk ever comes to happen, then the insurance company will pay you $100 for every $1 that you gave them in premiums. So it's literally pennies on the dollar. But here's where it gets interesting. Risk does not stay the same your whole life. As your life changes, your risk changes too. When you were younger, the biggest risk that you have is income stopping. When you're older, the biggest risk you have is living too long and running out of money. Different stage, different main risk. Sometimes the answer is insurance. So different risk becomes at a different stage. So sometimes the answer might be insurance. I need to insure my income, for example. Sometimes the answer might be changing your deductibles. I'll tell you a story later. And just balancing out where you're focusing your risk. And sometimes it's just moving assets around. Like the older person who has more assets than risk will be more looking at insurance as a way, looking at exposure by moving assets around to balance out the risk. So the tool changes, but the goal stays the same. And that's why we break life into 3 simple pillars: early career, midlife, and then legacy. But the key is the type of risk shifts from mortality to taxation and then to care. So these are the 3 major pillars of risk. The first one is singles, early career. If you are single, you are the engine. You are your main economical engine. If you cannot work, money stops, but rent continues, bills continues, any debt that you have continues to compound. You might have student loans, those continue to compound. They don't stop just because you lose your job. So your biggest asset is your ability to continue to earn. It's not your car, it's not your savings, it's definitely your income. So you have to protect that engine first. And then after you do that, the secondary risk that you have as a young person is your insurability. Young people, as I mentioned earlier, have the lowest cost of insurance and have the most options available to them. This is the stage when protection is easiest to lock in. You're still healthy, you're young, but unfortunately, a lot of young people, they dismiss that. They don't take advantage of that opportunity and they let it pass. When you're single, the risk is personal. It's about protecting your momentum, okay? But the moment sometimes depends on you. Even one child, the risk stops being personal. It becomes bigger and more contagious, you see? If something happens to you, your ability to make money, multiple lives can be destabilized. Now we're not only protecting your life, your lifestyle, we're protecting your stability of you and your family. This is in the expansion phase. You're mid-career, you're maybe in your 40s, your 50s, and there's a lot that depends on you. You have fixed expenses, you have a mortgage, you have perhaps a child who depends on you, and maybe maybe your spouse is a stay-at-home spouse taking care of the child. So you only have one single income that you rely on. It's very, very important in this stage to protect your income. Because if your income stops, it's not just about a small inconvenience. The dominoes start to fall. Families are very, very fragile to shock in this stage. That's why, again, protecting your income becomes non-negotiable. It's very, very important. Because and you find a lot of times that many families protect many small things very, very well, but they're not protected enough for the major risks, like income loss or even a lawsuit. Imagine, remember, like once you're having a family, there's a lot more moving parts. You have assets that somebody might want to come for you for. Your children, you can't control them. They might be out there and do something silly and end in a lawsuit. You have a reputation to manage. You hear all these people getting canceled on social media for saying something accidentally or exposing the wrong thing. So lawsuits can come out of nowhere because you have a lot to lose. So it's important that you protect your income, your reputation, and all of this can be done through insurance. I want you to ask yourself this. If income stopped tomorrow, how long would your family be okay? Could one accident undo everything that you've built? If you were one crisis away from starting all over, you need to pause and think, am I too exposed? And in the last stage, at some point, something interesting happens. The kids leave, the mortgage shrinks, and the noise quiets down. And suddenly, the question isn't, what happens if I die? It becomes, what happens if I live 30 more years? Because medical costs can rise faster than income. Long-term care is very expensive. Markets can go up and down. If you must sell investments in a bad market, the damage can be permanent because you don't have much time to wait and let the market recover. By the time you're 65, you're retired. You're starting to take money out of your investments and your savings. You don't have time to sit there and wait for the market to recover. So insurance here may provide stability through certain protections like what we call sequence of returns. In products like fixed index annuities, it can give you stability of income. Okay. It can also insurance can also provide liquidity, which means like money, cash, in products like guaranteed lifetime income or high cash value products that can pay you a guaranteed paycheck every month based on the investments that you put in early. Another area that insurance can help in this stage is tax help. When you were younger, you would have set up products that offer tax-free loans and withdrawals, like some of these cash value assets that we talked about. Another area that's very important is care, long-term care. You see, once you're older, you might need assistance at home, monitoring long-term care. Maybe you have some illnesses that you need someone to take a look at constantly for you. And today it's becoming more and more expensive. But if you planned ahead, you might have found hybrid policies like the combine life insurance and long-term care and allow you to leverage your dollars. For example, you can take $100,000 from some of your savings at that point and put them into a hybrid policy that combines life insurance and long-term care, which would then immediately give you access to 300,000 pool of long-term care. And let's say you don't even need that money for long-term care, and you miraculously don't need long-term care, and you're healthy the rest of the time, or maybe you use a little bit but not all of it. Then you can leave that money and it goes to your heirs as a death benefit. So it isn't lost, okay? So the job of insurance changes. The need does not change, okay? The next thing here that I wanted to discuss with you is a secondary risk that people in their retirement years tend to face, and that's ensuring that your wealth transfers without losing 30 to 40% of it to the government on your assets, okay? So it's about passing your money correctly from yourself to your intended beneficiaries, okay? If assets are not structured properly, part of what you built can be lost to delays in probate court, trying to figure out who the money goes to and who takes a cut and who gets paid. Some money goes to lawyers, some money goes to taxes. And this usually comes because there was not good beneficiary setup ahead of time. And in some cases, you might be forced to sell those investments so that it can be split out and divided amongst the people that are looking to get a share. And if they sell them at a wrong time when the market is down, for example, you lose a lot of your hard-earned savings. That's what I mean by government haircut, really. It's not because taxes are bad, but because structure is really important in this stage. So insurance, how it can help is in three main ways. It can create instant cash, so assets don't need to be sold. And you can continue to receive the cash while the principal and assets continue to grow. It can also help to equalize inheritance between the children so that they all get equal division of your assets, okay? And lastly, it can reduce tax impact when used correctly. So the goal is simple here. You worked hard to build your treasure chest, so the right people should receive it smoothly with no problems, okay? Let me show you how easy it is to misjudge risk. And I learned this the hard way, okay? I'll give you an example. 9 months ago, I bought a brand new car. It was worth $30,000. It smelled great. It drove even better. Then life happened. It completely totaled it in an accident. And then I had insurance though, so the appraiser looked at my 9-month-old baby and told me it was now worth $26,000. In less than 1 year, 4,000 of my net worth had literally evaporated into thin air before I even hit a single pothole, okay? But this is where it gets interesting. to protect me from that, to protect me and that $30,000 asset, which was actually a diminishing liability now that I think about it, I was paying $400 a month in insurance. This covered me with a $1,000 deductible because I didn't want to be bothered by a $1,000 surprise, you know? That's all I thought I could handle. But get this, I was paying $4,800 a year to make sure that if I crashed, I wouldn't have to cough up an extra $1,500. Think about that, math. Okay. I was paying $5,000, nearly $5,000, to protect myself from a $1,500 risk. Does that make sense? So when the car was gone, I realized one thing. The car didn't matter. I could buy a beater for $5,000 and still go to work. The car wasn't the wealth generator. I was, you see? So if you are a 30-year-old like me, making even, let's say, $83,000 per year, and you have a 3% raise annually, which most companies give, I calculated this and turns out you will earn roughly $5 million before you retire by age 65. So in 35 years, if you make 83,000 per year with a 3% raise, you'll have your total earning years will earn you $5 million by retirement. So my income really is the real asset to protect. Your ability to show up to work every day is a $5 million asset. If this machine breaks down due to illness or injury, the 5 million disappears instantly. The 400 I was burning every month in car insurance to protect a piece of metal, it won't pay a dime toward my mortgage or groceries. You see? And many of us do this. We spend thousands of money to insure the small things we can afford to replace, like phones, car fenders, appliances. But we leave the one thing that we cannot afford to lose, our income, completely exposed. So look at that slide again. Are you spending $400 a month to protect a $1,000 risk while leaving $5 million risk to chance? You need to realize, like I did, like that you are the most expensive asset that you own. And even when people do buy protection, there's another problem. Most policies fail for simple reasons. Either they were too big for the budget, or they were too small to help to cover the exposure, or the person did not even understand them. They just signed on the dotted line. Or no one reviewed them. Not the producer, not the policyholder. He just signed and forgot about it. Protection should bring peace, not confusion, and definitely not stress. If it is built correctly, it works, just quietly works, you see? And this is where clarity in the process will create confidence in the policy owner. And then the real question becomes, where are you exposed right now? Not 5 years ago, not someday, right now. Okay, tonight, it's about awareness. To know that different ages comes with different risks. And if the risk changes, the plan should change along with it. So here are two simple invitations, okay? If you are a household or an individual, let's map your risk exposure. And if you're an analytical thinker, learn how to evaluate risk correctly. And if you're not sure what your biggest risk is right now, that is a good reason to meet for 20 minutes. Not for me to sell you anything, but to review. If everything is solid, I will tell you that. And if there's a gap, then we fix it. Either way, you leave clearer. Okay? We cannot control everything. We cannot control markets. We cannot control our health. Can definitely not control timing, but we can prepare. Wise people prepare for what they cannot control. Hope feels good, but structure feels better. And structure becomes even clearer when we see real examples. So at this point, I'd like to bring up my co-host, financial architect, Mrs. Usinje. She's going to walk us through a few practical scenarios and product examples, not to overwhelm you, but to help you to see how this structure looks in real life, okay? Because ideas are powerful, but seeing them applied makes them stick, okay? Mrs. Usinje, over to you.
Oh, thank you so very much, Collins. That was beautifully done. Ku bantu bacu wenda batakurikiye cyane, twabijeje ko tuza kuganira mu ndimi zose kugira ngo twese tubashe gukurikira neza. Ngira ngo twanumvikanye ko muza kubika ibibazo byanyu byose mukabaza mu rurimi rwose mwifuza kubazamo. Collins atubwira ibintu byinshi kandi byiza. Ngira ngo cyane cyane navuga ko to sum up wenda mu byinshi atubwiye timing is key. Nta bintu byo gutegereza nicyo kitwica twese, ngo njye ndi muto nta kibazo kirabaho, ngo nta bana ndagira. So timing is key, kubera ko muri life insurance there is no guarantee. Nta muntu uri guaranteed insurability. Ushobora kubyuka uyu munsi wari muzima, wari umusore, wari muto, ukarwara uburwayi butuma utabasha kongera kubona ubwo bwishingizi. So I think the timing is today, making sure ko mu bintu byose twitaho, mu bintu byose tugerageza guproteja ubuzima bwacu, abacu n'ibyacu bigomba kuza mbere. Ngira ngo nk'uko dusanzwe tuganira hano, iki ni ikiganiro cya community kiri open ku muntu wese, waba uri muri industry zindi, we welcome you. Waba ukora n'izindi company zose, n'abanyamo ba Bosco barimo hano, welcome, come learn with us. Iyi ni opportunity rwose ya community kuza tukigana, tukungurana ubumenyi kugira ngo tubashe gufasha imiryango yacu. Akenshi ni usanga nk'uko kuri station yacu bavugaga, mbere y'uko umuntu afata ubwishingizi ugomba kumenya wifuza umuryango wawe n'ubuhe wifuza, kugira ngo ubashe koko guteganyiriza umuryango wawe wifuza. Arakoze Engineer Colin for the great presentation. Ngira ngo ngewe ibyinshi yabikoze. I will sum up with just the needs analysis. Buri muntu wese yifuza gukora mbere y'uko yagira ubwishingizi ubwo aribwo bwose yafata, nicyo turi bwifuze kuza kurebera hamwe gusa, naho ibindi ndibaza ko yabiganiriye. Tubashe kubaha akanya kugira ngo namwe muze gutanga ibitekerezo n'ibibazo byanyu. Nkuko nanabivuze kare, nitwa Immaculate Businge, ndi umu financial professional. I love to share with my community. I love to learn with my community. Sinibirirwe nca muri byinshi cyane. Collins yabinyuzemo fundamentals za life insurance, purpose yayo ni iyihe, financial needs z'umuntu ni izihe, coverage options, appropriate coverages. Akenshi twisanga ibibazo dukunda guhura byo n'imiryango yacu, abantu bafata ubwishingizi badashoboye bikazabagora, ariko turaza kurebera hamwe turebe neza. Ntabwo tuza guca mu bintu byinshi bikabije, tureba bikeya biza kubasha kudufasha kugira ngo umenye ngo ubusanzwe ese ubundi nifuza ubwishingizi bwo guproteje umuryango wanjye. If I need a life insurance to insure my family, to insure myself, how much life insurance do I need? Like we always discuss, like we always share, life insurance is not a one shoe fitting all. Buri muryango, every family has a different financial need. Every family has different protection needs. So here it says how much you need depends on your goals. But one rule of thumb says 5 to 7 times your gross annual income. The reason being, when you're protecting yourself, you're not just protecting yourself today, you're protecting yourself for months and for generations to come. Some people just want enough to cover last expense, that is final expense. Others would leave a significant amount for their family or even charity if you don't have the family to leave the money on. So my focus today actually will be on calculating your insurance needs, what we call simple needs analysis. Before you get covered, mbere yuko uhitamo ubwishingizi ushaka, banze wicare wowe n'umuryango wawe cyangwa nawe ubwawe financial professional uzi neza uburyo bakora needs analysis, mbere yuko umuntu akubwira ngo fata ubwishingizi bwa miliyoni cyangwa se fata ubwishingizi bwa miliyoni 2, banze umenye ngo ese ubundi niki ngerageza gushingana, niki ngerageza guproteja. So when we talk about needs analysis here, this is what we're looking at. Before you know how much you're going to take, before you know how much you want to put into this investment, look at this. You're looking for to make sure that your final expense is going to be covered when you're no longer there. What are those final expenses? Funeral expense, medical expenses. The medical, before someone goes, obviously they go through hospitals. There are medical bills piling there, and hospital expenses. This is number one obstacle or issues we always have in our communities, whereby someone is gone and GoFundMes are flocking all over the place. Iki ni cya gihe tujya muri panic mode, ugasanga umuryango ubuze umuntu umwanya wo kugira ngo ugire wa mwanya wo kugira kuroja, batangiye kwibaza ngo turabigenza dute. Tukwiriye kuva muri panic mode tukajya muri planning mode. Abanyarwanda, abanyafrika, abantu bari twebwe dukunda kwigira yo turiho, kwikorera tukamenya ngo imiryango yacu imeze neza. Umunsi umuryango wagize ibyago ntabwo ari umunsi wo gupanika ngo tujye muri panic mode. Ni cya gihe cyo kumva ngo uyu ni umwanya wo kwegera n'imiryango tukajya muri closure instead of panicking. Ikindi kintu ubureba noneho iyo utekereza ubwishingizi ukeneye ni outstanding debt. Ese mfite imyenda nishyuraga kubera ko njya ku kazi nkinjiza sheke? Do I have debts? Do I have a mortgage to pay? Do I have some loans? Maybe those could be credit card loans. They could be student loans for those who went to school here. They could be car loans. All these outstanding debts are being paid because you're able to go to work and service them. Think about that. If you have a home, you just got a home, you're paying that mortgage because you're able to bring a check. What happens when you're hit by a critical illness? What happens when you hit with a chronic? What happens? Who pays those bills? Those are actually the reasons we get life insurance. Do I have children? Are my children ready or set up for college? Who is going to pay for my children's college if I'm sick or if I'm gone and I'm not able to actually cater for that, or if I didn't plan accordingly for that? Mfite babana bifuza kuzajya kwiga, narabateganyirije. Zimwe mu mpamvu tugomba kurebera hamwe ni izo ngizo mbere yo gufata ubwishingizi. Ikindi, family income needs, annual income requirements for your family. When you're sick and you can't go to work, when you're gone, who is going to take care of those beautiful kids you have, or even your spouse? Those are the reasons we look at. when we sit with you as professionals, we look at all those to make sure that we give you a coverage that is going to take care of all those needs of yours. Legal costs, if you happen to go into state probates or attorney fees, how are you going to cover that? So this is what we want to make you to make sure that you understand even before you sit with a financial professional telling you to get $1 million or $2 million or $5 million or 500,000. Know your budget, know your needs, know what you're covering. That now we come to that real needs analysis now. Here we gave an example of a younger couple, Emma and Keza. They are both 30 years old. They are newly, they are young, they have one child. They have, unfortunately, like many Americans or many of us, they have some loans, they have some debts, car loans, credit cards, student loans. Each of them, you can see, each of them, as you can see, a young couple like that, 30 years old, most likely the debts are at the highest. They have those debts, they have car loans, they have credit cards, student loans. Each of them, the husband is standing at 80,000 just on the debts. The wife is standing at 60,000. Look at the final expense. Final expense here, each of them, that is actually a minimum. For those people who have lost a loved one or even who have seen people suffering within this regard, final expense nowadays to actually making sure that someone is put to rest, it takes some good money. So we just put 20,000. That is an estimate. It's not a final number. This younger couple has a mortgage now, as of now, standing at 400,000. Meaning that if something was to happen to any of those, either Emma or Keza, the remaining spouse is going to have to suffer with all those debts. So this is what we do when we sit with you. We look at everything. Do you have those debts? What do you think if something was to happen to you? Are you set? Do you save some money up for final expense? Do you have some money to pay off your mortgage if something happened to you so you don't leave your spouse and your child in danger? They have one child. We estimated that this is even an estimate, 100,000 for even finishing college might not even be enough. But this is just to show you what we do with you when we sit to analyze your financial need. And then comes the income replacement. Even 300 is not enough. So looking at this young couple, Emma and Keza, we're estimating total life insurance needed at 900 for Emma and 880,000 for the wife, Keza. So before you meet a client and tell them, oh, get $1 million or $2 million, first find out their needs. This is going to help you or even help your client, even you as a client, to understand that, hey, this is my need. I need 900,000. Do I have enough premiums? Do I have enough money to get this 900,000 life insurance? If so, which option do I get? Do I pick the permanent life insurance? Do I pick a term life insurance because it's cheaper? This is where we come in as professionals. Most of the time, you don't have to break your bank to cover your family or yourself. It takes one actually specialized financial professional to work with you. You could get a hybrid here. You mix up your options. You pick a permanent life plus a short-term or term life to make sure that your needs are met, but you're not breaking your bank. Remember, the mortgage, most of the time, at the maximum is 30 years. Those loans, student loans, are going to be paid up anyway. You're not going to go for over 30 years. If you took a term for 30 years or 35, for the 30-year-old, $50 gives you over 500,000. That cuts your 900,000 needed insurance into almost, you have a balance of 400,000. it's going to be easy for you to pick up an index universal life for 400,000 instead of picking 900,000. If you can afford to pick a permanent life altogether, that means if you have the capability, you have the funds to fund that, go ahead and buy a permanent life insurance, because the younger you buy it, you lock in your premiums, you lock in your age, you lock in your health. It is it's better for you to get it as younger you are. But if you cannot afford to pay, say, $500 every month because you're 30 years old, you still have a big mortgage, you have everything still like too much on your plate, actually talk to your advisor. They can give you a good price that is not going to break your bank, but you're able to make sure that, remember, the focus here is protection first. Protecting yourself, protecting your family, not the kind of policy you're taking. Remember, some of these products, like indexed universal life insurance, you could start paying $200 and increase it to $1,000 as your finances gets better. So don't delay your protection. Don't delay protecting your family because you're waiting for the big check, because you're waiting for some bills to go away, because you never know what tomorrow will bring. That was an example number one. Example number one for a young couple who are 30 years old of age. The difference is different. You can see that. Now we jump to couple number two, John and Joanne. They are 50 years of age. At most of the time, at this age, the needs are different. They are getting older. They are more worried about where they are going. They are heading towards retirement. Most of the time, some of the debts have been cut into, at least they are getting smaller. But at the same time, they are worried about where they're heading. Are they set with their retirement planning? Because most of these policies, like index universal life, it comes with two components, the protection and the savings or accumulation. The protection is going to protect your family, yourself, whether you get a critical illness, a terminal illness, a chronic illness, or God forbid if you die. But if you don't die and you're lucky to live a long life, which we all want, you're going to be saving money towards your retirement. So looking at this couple, the debts are getting minimal, 20,000 versus 80,000 for the young couple. Final expense, of course, stays the same. The mortgage is becoming less. It's 100,000 instead of 400. Education, they are lucky they had their children early. Now their child is already done with college, so they are happy. They no longer have planning for college, but they are worried about replacement of their income just in case one of them was to be sick and the other one is working alone. When we talk to a couple like this, we're focusing more now into their retirement. We have fixed annuities that are very, very good for the older people. We have even those index universal life insurance. You can even jumpstart it. Put your money. We tell people, if you worked with the company ABC and you're no longer there, you left your 401k there, we can actually roll it over to your annuities. You're going to save better money and you're going to be paid for life as you get into retirement. As you can see here, the life insurance needed for this couple looks smaller, even a half of the young couple. But guess what? Their cost is now, it might even be more expensive than the 30-year-olds because their insurability is getting tougher. Insurance, as Corinne told us, is cheaper with age, cheaper with health. Most likely when you get into your 50s, some chronicles are starting to kick in, even the pricing becomes high. So we encourage people, take your coverage as soon as you can. The earliest you did it is now, because tomorrow adds another day for you. So before you pick anything, before you pick any policy, don't say, oh, a term is not good. Protection is good, whichever you take, as long as that is what you can afford, take it. Take what you can afford as you wait to get what you want. It's always better to be protected today than actually regretting tomorrow because you're waiting to get $1,000 to get an IUL when you're 50, instead of being able to pay $200 or $300 and get $1 million when you're 50 here. So I tell my people, we tell our people all the time, sit with a financial professional who is willing to go with you, to go deeper into what you can afford. I never tell my clients get $1 million because I don't know what you want. I don't know your capabilities. I don't know your needs. We have to go through the needs analysis to make sure that we're covering you, we give you an option that actually works with you. This is actually, we have like two main types of life insurance. The term life that I always tell people, the term life is usually, referred to as like the same way you rent your apartment or you rent your home. You get a rental agreement for 30, 35 years, but you're still living in a home anyways. I tell my people, whether you're renting or you have a mortgage, the one with a mortgage is renting from the bank. The one who is renting from the owner. So whether you have a term life, you are protected. Whether you have a permanent, you're protected. The end goal might be different, but all of you are protected. So when we look into actually the benefits of term life insurance that some people tend to think that is useless, let me tell you, even myself, I have one, I have two. I have a permanent and a term life, because this one you pay in $50, you get over 500,000. That cuts into the burden of paying $1,000 every month, and then you have the other piece as a permanent life insurance. So for this one, like the name says, it's a term. It terminates at one point after, if you take one for 10 years or 20 or 35, depending again on your need. If your need was to cover for your to make sure that you're covered until your mortgage is done, take 35 and you're done. If you already know that you secured your future, and what you're ready for is those years whereby your kids are younger, your mortgage is not paid, go ahead and pick up a term. It does come with living benefits as well. So it is not just a death insurance. It's a life insurance that comes with a tax-free death benefit, tax-free living benefits. You don't have to worry about the index if you can't afford it. What you need is what you get. So this one pay only for protection against death and death benefit and the living benefits. It does not have, again, it does not have cash value accumulation, because this is specifically designed for protection. The death benefits are paid if insured dies during the term. If you get a 35 years, you have to remember that you have to cover the other years, because you, again, only protected during the years that you did. The premiums remain level. They never actually increase. The products we do have, if you get a 35-year term, you're going to be paying, if you're paying $100, that is what you're paying for the rest of 35. It's not going to change. Whether you get sick or whether you're gone, your family is going to be protected. It can be renewed without additional underwriting, but most of the time, when you renew that, if you want to change your term life after 35, you can imagine if you took it at 30 or 25, you're going to be 65. So it's going to be costly. That is why I always advise my people, if you can, do a hybrid, the one that takes you from those risk years and the ones that is going to take you over through your life. So it can be expensive if you insured life. It can be more expensive if insured lives beyond the term. Of course, that is why, again, we're advising you to make sure that you're looking into now and the future. But we sit with you, we show you everything. What helps you is your, again, affordability. Can you afford a whole life? Yes, that is the best option, because you're going to lock in everything until for the rest of your life, and you're protected. At the same time, you have those savings. And then that is the beautiful index universal life insurance. Always we tell people, this one hedges for everything. The it has the fixed interest crediting options that are actually plus the index crediting. Here you earn your money. You're protected today when you get sick. tomorrow when you die, the future when you live longer, which we all really need. So again, looking at what we're on our flyer, sit with a professional, know exactly what you want. Oh, these products are beautiful, depending on your need. My need, my family needs is different from your need. My affordability and your affordability is different. Don't go with what I took. Maybe I took a term because I have investments for the future. Maybe I took an IUL because I don't have anything for the future. Maybe I took an IUL because I can afford it. I can afford to pay $1,000 for $1 million protection. Again, when you get $1 million protection, you're now becoming a millionaire because you're not dying tomorrow. The purpose here, again, is protection. So what are the action? What action should we all take? Get what you can afford. Lock in the low rates today. What you can afford. I'm not talking about any product here. I'm not talking about the IUL. I'm not talking about the term. Get what you can afford. You cannot get an IUL that is for $200 or $300 and increase it later as you go, because when you increase, you don't have to go through medical checks again because you're already in the system. We increase your premiums, protect your family and the future income. When you get a life insurance, it's not just you. It's you, your income, your family, and your generations to come. Grow wealth tax-free and use it when needed. It feels so good when you save today, and when you're retired, you don't have to stress because you already thought about that long term. Get living benefits for medical emergencies. We never know. We all never know when we can get sick. Everybody's always like, you feel like I'm good today, I'm young, I'm good, and nothing can happen, but you never know what more brings. So always get prepared. Know your options, know your needs, know your capabilities, and actually plan ahead of time. So these sessions, we do them every Thursday, 8 p.m. Central Time. Every week, we have different presenters, we have different topics, and we always actually look up to you. Tell us what you want us to learn about. We are here to educate our communities for free. We don't charge you to come. Come learn. They say information is power. An educated community is a progressive community. So let us learn together. We have our contact numbers here. You can call any of us on the flyer. You have the flyer as well. We would love to hear from you. Send us some topics you want us to cover. We cover different stuff from real estate to taxes to actually how to better your credit, how to save, to prepare to buy a home. We do everything. We're not just life insurance agents here. We are financial professionals. We are here to work with you to better your life and to better your families. I think we'll go ahead and stop from here because we need to hear from you. If you have some beautiful questions you kept for us, we need to hear that so that we can be able to learn from you as well. Thank you for listening. If you will, please, you can also put those, the questions in the chat, or you can actually raise your hand and ask. Mwakoze cyane kutwihanganira, mujye mutubabarira, dufite abantu bavuga indimi zitandukanye, tugerageza uburyo bushoboka byose kugira ngo buri muntu wese ave hano hari ukuntu afite ikintu yize, atagenda uko yaje, ariko nanone tugerageza kugira ngo buri umwe wese yiyumve muri izi nyigisho zacu, kuko ziri hano kugira ngo zidufashe nk'imiryango, zidufashe nka communities. So open your mics and let us know if you have any questions. Or ikindi, the recording is going to be out by tomorrow morning. Look out for it. Aho wayikuye n'ubundi uzasubireho, niba waje ukererewe utabashije gukurikira byose, we'll share the recording for you. N'abandi bose wabaha kugira ngo babashe gukurikira. Murakoze.
Thank you so much. The presentation was very helpful. Well done, very inspirational, and we work hard, to achieve protection in our communities and to spread the knowledge that's so needed.
Thank you so very much, Nema. This is the goal. This is the crusade we are on as professionals, to make sure that we're giving back to our communities. Thank you.
That's right.
because actually we have a YouTube link. When we share the recording, you're going to see our YouTube link. You can always go in there, share something you want to share, or even write to us directly. We do have our numbers on the flyer. Feel free to reach out to any of us. I know this is a little late, 9 p.m. Eastern, 9 p.m. Central, 10 p.m. Eastern time. It's getting late. I think if no one has a burning question, we can go ahead and close. We'll go for 1, 2, 3. If no one has something, ntihagire ucikanwa uniganwa ijambo. Ufite icyo ashaka kubaza, icyo ashaka kongeraho before we close. Thank you. You're most welcome, Melissa. All right, Collins, please go ahead and give us your closing remarks. So go ahead and close that just to save time here. Go ahead, Collins.
Just want to echo your last words there too, is that even the last question is a strong question. I appreciate all the questions, but most of them depend on your personal circumstances, your personal numbers. That's why group settings are usually good for learning, but personal reviews are better for decisions. So if you'd like clarity on your particular situation, we'll open time this week. Then if you want to stop by and have a chat, my contact information has been shared. Thank you very much.
Thank you so very much once again, Collins. Mwakoze mwese. For everyone who came in tonight, come back again next Thursday, same time, same link. Don't miss out. This is free education. We are better together when we learn together. A very great evening once again. See you again next Thursday, same time, same link. Have a great night.